It's a pleasure to be here, and we have put together 9 topics we're going to talk about in the next 75 minutes or so.
Yeah.
Right? And we'll give our perspective from a venture investing perspective. So perhaps you'll get a sense of what we look to see in companies that you've invested in that then come to us at a later stage, a little bit of a later stage. And then we'll also talk about some investing concepts that we use in evaluating companies, deal managing them post-investment, and so on. And if you look at, oh, where's that? Oops. Okay, it's not there. But these are the concepts that we're going to go through at a high level, just so you know. And what we'll do is for each of these, we'll talk to each other for a little bit about the area. We'll open up for maybe one question in that area, and we'll move on to the next topic. And we'd love for this to be a back and forth in these areas, right?
Yeah, unless we get one question on each topic, we're not moving to the next one.
That's right. So these are some of the areas, just so you keep it in mind. Portfolio construction, founding team, market, model, deal negotiation, co-investors or who you should pick as co-investors, staying in sync with founders post-investment, not exit negotiation, but just exit decision. How do you make that? How do you set up for that? Crucial relationships for angel investors to have if you're viewing this as a more long-term initiative that you're going to have over a number of years investing in multiple companies. And then we'll end with currently active themes. What are the areas that we're seeing that Series A seed investors are getting into, and therefore you can make your decision as to whether you wanted to go into those areas or other areas. Does that make sense? Yeah?
Great. So should we start with...
Yeah, I'll start with the other end.
Should we? Okay.
Yeah, why don't we do that?
Happy to do that, yeah. So, portfolio construction, right? I mean, when I joined this business, 2007, I just thought you just have to go and invest in companies, right? And eventually figured out that it's about how the portfolio moves, because each company usually is destined to fail, right? And after 60 odd investments in 10 years, this is what I've learned. The portfolio matters more than each individual company. So, I think starting with you, if you can share how we construct a portfolio as a number of companies, ownership in each, and then I'll share what we do.
Yeah, I'll talk about it from a portfolio perspective, and this is how venture investors or some venture investors think about it. You may choose to think about your portfolio as you expand your angel investments in this way or a different way for that matter. So I'll just take an example of a mythical $100 million fund, let's say. And we both have fund sizes that are different from that, but just to put round numbers. And you want to typically reinvest in a, let's say, a 3 to 4 year period, right? And we typically, for that size, we'd want to say we want to invest in roughly, let's say, 15 or 20 companies, right? And so you can imagine over 3 years, that means 5-7 companies a year on average. There's no such rule that you have to invest that many per year, but if the right companies come along, that's how many one could end up investing in. Now, what we think about in portfolio construction is diversification, both in terms of time, in terms of sector, and in terms of stage, right? And you want to think about where you want to focus in these areas. So in terms of time, it'll be don't make all your investments in 1 6-month period and then wait for the next couple of years and do nothing. You want to space it out over time a little bit so that the vagaries of the market don't affect you. I'll give you an example. If you do all your seed investments in this quarter, right, the likelihood is that those companies will all come up for a subsequent financing in a 12 to 18 month period from now. What happens if the market turns down 9 months from now? All your companies are coming for financing at the same time will face difficulties, right? That's just one example of timing. Absolutely. I don't know if you want to talk about some of the other areas.
Same thing happened with us. We had 7 companies in 2015. Thankfully, all of them had raised money the follow-on round in 2015 itself. Right? If that had not happened, we all know that 16 and 17 were not great years for for follow-on rounds, and most of these companies would have died. One question that gets asked to me from many of my good friends who start companies or angels, right? This is going to be a 5x. So the way to construct a portfolio, and it will vary for different funds. The way we see is that each investment has to return the whole fund, right? And a very common concept. Maybe that's not how SoftBank decides, right? But pretty much you and I would think of each company as a fund returner. And what happens is that you then take the probability. What are the chances, right? Even the best of the founders, best of the companies, what are the chances that this one company is going to return 100 million for me, which means that the company has to be, let's say if you're holding 15-20%, the company has to be a $500 to $600 million in exit, right? Or maybe even $1 billion, because you might dilute down to 10% holding by the time it's sold. It's important to keep that filter. I have passed on many good companies where the company raised money at $1 million and exited at 6, 8. Right? They would have been maybe decent opportunities, but we did not invest, and no regrets, because they just didn't really mean much for the fund. Sometimes it looks like there is a difference in probability of these successes, right? It's easier for let's say an analytics company to go from 1x to 1 million to 10 million valuation gets sold, but that doesn't happen, right? I mean, if you really look at the probability of each of these companies, you by and large will find that not more than 1 out of 10 will really go anywhere. And you have to believe in these numbers. There will be some people like Muru here, or some super angels who will really have very differentiated access to deals. Their portfolio might be outlier. They definitely would outperform even a fund like ours. But I would otherwise say that each company has an equal probability, and hence each company has to return the whole fund.
Yeah. Just to finish the concept, and then we'll take a question. Stage diversification means not just, and this maybe applies to funds more than individual angel investors, but look at seeds, look at Series A's, look at Series B's, so that there's some diversification there. And then the final one, resector. Don't put all your eggs in one basket, absolutely, in terms of only e-commerce deals or only on-demand or only software companies. Just diversify a bit there, because different companies meet different market conditions, and so overall you're better off with a diversified portfolio than all your eggs being in one basket. So I think leave it at that. Maybe take a question for this specific topic. Is there a question that you want to ask on portfolio construction? So I'll repeat the question once you say it to me. Yeah.
I need some more clarity.
If you just tell me the question, I'll repeat it.
I need some more clarity on the third point which you mentioned, different stage you have to invest.
Different stage diversification.
So the question was, she'd like some more clarity on stage diversification. What does that mean? Like I said earlier, maybe it applies to institutional funds more than angel investors, but what it means is that all other things being equal, don't invest only in companies that are pre-launch, let's say. Right? Think about pre-launch companies that have already launched in the market, maybe companies that have some revenue, sort of diversify from a company development perspective, so that you're not all stuck in one basket. That's all I mean there. And all that means is that, again, that also helps with time diversification, that helps with different access to different pools of capital when they need the next round, different types of recruiting help they'll need. So it helps you also spend your time wisely between those companies if you're looking to be a little bit more involved.
It's not linked to only valuation, right? Within the early stage also, there are different stages. Some plans are just on a PPT, and some plans you can see the product. In some cases you can actually see enough proof of sale or initial product market fit there.
I think one other area that one stage where sometimes angels get invited in is when institutional funds do a round. They might say, we're going to leave a little bit of a slug off for that round for value-added angels to come in. That's another stage in a sense. You might be called and said, can you please come into the Series A round? So that way you can diversify stages between pre-Series A, Series A, seed, angel, Let's think about that a little bit. Okay, so in the interest of time, we'll move on to the next one. Founding team. I think the idea here was when you're meeting entrepreneurs for the first time, you have 3 or 4 meetings. As angels, maybe you only have a couple of meetings. Then you have to decide, what do you do? And we have, as institutions, we have a little bit of a different process. If you want to elaborate.
We have this tick box thing that how many people have met this person, how many times, right? Between partners. Sometimes I'll meet alone, sometimes I meet with one more guy, then somebody else will go to their office and meet. Sometimes I meet them out for lunch, dinner. Try to meet the founders in various situations. If there are multiple founders, we try to spend time with each individual. What happens in teams is typically there will be one person who will be pitching, might be the CEO who is making the sales pitch, and that's where of course we end up spending most of the time, but we usually have a blind spot regarding the others and also regarding the chemistry between the founders. So we have some formula about our founders where we'd say that the team has to be complete in terms of both technology thinking and business thinking. So ends up being a team of 2 or 3 at least, and we would say that one person is a Facebook or Google level programmer, somebody who will get recruited instantly by Facebook or Google in terms of his programming smarts. And the other person would be like an investment banking level person who can actually go and sell any overvalued deal to SoftBank, right? So that would be the other person. And that's sort of a discipline, but try to understand their not just the market. So when we're talking to the founders, market is of course the first one, right? And while you are meeting, you are thinking about the market. But when you're talking to the founders, instead of assessing the market while talking to the founders, we are assessing the founders. Right? Then when the founder goes back, then we start thinking about the market, and then we do our research and talk to people, all of that. But consistency of how they're talking, those kind of things, their ambition, their drives, their needs and wants, their situations. For example, some people may just cannot handle a 250k round because the 2 guys had a salary package of 500k per year. Right? These people just can't manage. Right? You have to understand where they're coming from.
Yeah, I guess a couple of other concepts we use in evaluating management teams. One is we do a ton of reference checking, and you may or may not have time for that, but I would really encourage at least a couple of calls. Sometimes it's to other people that know them. Sometimes it's people you don't know that you're contacting for the first time to get an assessment of these. It's typically people they've worked with before in previous jobs or companies that they've started together. Sometimes if they're really young, we go all the way back to classmates in college. And we're really checking not only for knowledge about the domain that their startup is in. We're checking for people skills, we're checking for ethics and integrity, we're checking for transparency. Are they going to be open with us? Are they going to tell us their problems? Because post-investment, investing is only, getting into a deal is only like 10% of actually the work. Like the other 90%, the hard work is after that, which is, and we'll talk about that in this thing. So we want to check a little bit, how will we gel with them once we are working with them, right? Are they on the same wavelength? Do they have the same objectives? Do they have the same time frames? Are our visions for the company aligned? Or do we have a different vision for where the company should go and different vision and they have a different, then that's a tough thing to endure for 10 years, right? If people have different visions. So that alignment is what we look for, and typically we don't ask them for references, because typically the references you get from a founder is people who speak well of them. So it's kind of almost semi-useless to make those calls. We do back channel checks, people we know in the market who know them, and we sort of make sure we tell them, and we do this, that we're going to keep things confidential, it's only between us and them, and we don't then feed that data back to the founders or to anybody else. It is literally just for our evaluation purposes, and it's very revealing. What we look for there is what people don't say call after call about somebody, and sometimes what they say is also consistent from call to call that we make. Those are the sort of things we look for.
Yeah. So in fact, Dave, glad you mentioned the reference check. I've not mentioning the company name or anything, but I've had situations where like 7-8 years ago, 10 years ago or so, there was one founder who had an ethical issue. We have already invested, and we decided not to back the founder again. Right? The company was wound up. There was a group of angels who invested in the founder a larger sum of money, and the second company also went down, and again with similar ethical issues. And then there was a third group of angels who also funded the same founder. Interestingly, probably 20-30 odd people funded the guy in the last 6-7 years. Not a single one came for a reference check to me or any of my other fund partners. Which basically means that reference check is probably, I think what happens in angel is probably that you are getting a reference from somebody else, meaning another angel will refer a deal to you. Right? That doesn't mean that that angel has done actual reference checks of the founder. Right? I think that is something, I believe that Let's Venture takes care of some of that for you guys, but ideally it's good to do some of that on your own. There is also a lot to learn about good founders, because sometimes references teach us what kind of references are winners, right? And as you do pattern matching over the years, useful to have a database of reference checks in your mind.
Yeah. In the interest of time, again, I'll open it up for questions. Yeah, on founding team. Okay.
What's the most important question you will ask?
In reference checks?
Yeah.
Interesting question. I think one that I ask pretty often that I get revealing answers on is, where is the spike that this person has relative to their peers? What is it that they're world class at relative to their peers? And oftentimes I hear back, they're good, they're fine, but no, people can't put their finger on what they're really good at. That actually means something. And when you hear that consistently across reference checks, that's one question I ask.
Yeah, I just try to do the fact checks, Maroon. I would love to know a master question, but just try to correlate facts. Was this the role? What was the target? Because we ask the same questions to the founders. Just fact check is good enough. What happens is that once you get the person started, you are looking for the the referee to actually use words like exceptional in something, right? You don't ask, was the guy exceptional? Then you're forcing the person to say.
Right.
You just do fact check. Where did he work? Where was he based? What was his target? What was his exact role? And then the person will say anything you want to say about. The person will end up saying something. Say, he's a great guy. I really wish I had the money to invest in him, kind of things. Or the great guy has to do well. Maybe he was not a good fit for us. You're looking for that to come out automatically.
You don't want to lead the witness, is I guess part of what we're saying. You just want them to say what they really think.
Yeah.
Okay.
Sure.
When you fund a funding team where one or two members are still working elsewhere, subject to getting funds, they apply and join the funding.
So the question was, would we want fund founding teams where one or two of the founding team members are still working at other jobs, but would only join if the funding happened? I'll give you my answer at least. Generally, in Silicon Valley, where I was investing for 6-7 years before coming here 6-7 years ago, the answer would be generally a no, because that connotes lack of conviction in the business, in the startup. Generally speaking, here I've seen a little bit more of that. We recently signed a term sheet where that was happening, but the founders had already had the chat with their family, more importantly with their families.
Yeah.
Because a lot of times people are really excited about startups. Then when you actually give them, say, okay, here it is, they talk to their spouses or whatever, spouses are like, are you crazy? Our daughter's just about to go to college or whatever, why are you doing this? And then they pull back. So I think we like people to actually have committed, because that means something. That means they've burnt their bridges to the past. They're not hedging their bets.
No, I would say again, generally no. In one situation, I said I will not give you a term sheet. I take your word that you're really too keen to do this. You take my word, I'll give you a term sheet, right? But only after you resign and you come out of the company clean, properly.
Okay.
I think there are some questions.
Okay.
Sure.
Well,
Unless we
we'll
can't cover it later. Sure.
So any experience of family members being founding team part of that?
Oh yeah, husband wife is the most common, right? So
Like I've backed a couple of teams where it's been founding family members. There's a company called SlideShare that is a US India company, social media company I've backed in 2008. Had a fantastic outcome. They sold to LinkedIn. And then we're investors in a company called Byju's, which is a fantastic team and doing really well. We've had good experiences on that front. I think the question people have sometimes is are people going to be evaluated on performance, or are they going to be kept there despite bad performance? And I've only had good experiences as long as I have had that chat with the founders before investing.
yeah, I'd have no problems, but I would then be slightly more rigorous on evaluating each founder separately and just test whether each one of them independently deserves to be like the two brothers, two sisters, husband, wife. Whether each one of them independently deserves to be a founding member, or is one just riding piggyback on the other. But otherwise, I don't think there is a big issue there. We've had two very successful companies in that model. The bigger problem is where founders sometimes are in a relationship and don't disclose. That could be a problem. Sorry. Yeah, we've dwelt a lot, but yeah, sorry.
One last question and then we'll move on.
Do you like founders who come to the company completely empty-handed, or like people who raise some amount of capital themselves?
You just want to repeat the question. I think the mic was not
He's
on.
saying that do you like founders who come completely empty-handed, don't invest any money in the company, or do you like founders who invest a lot of personal or some personal capital into the company? Young founders just don't have any money, right? And yeah, I think that's about it. They don't have, and it's okay. Most people, there are other ways to assess skin in the game.
I don't expect that at all.
Yeah.
Yeah. Okay, we'll move on. The next one is evaluating the market that a company is in.
And Dave is going to talk about it solely because that's what I am also here to learn from him.
Come on, we've co-invested. I've invested in a company of yours where you obviously
I got
thought
lucky.
about the market.
I just got lucky.
We're co-investors in a company called ShareChat, which is a social media company. But in terms of market, this is a little bit of a tough one in India because sometimes there's not enough data. And when we're talking about technology investments and internet investments, some of those markets don't exist online necessarily. 5 years ago, would you have said there's an online education market? Probably not. 10 years ago, would you have said, are people buying things online? No. But people invest in those companies and have very nice outcomes. Flipkart, for example, is an example of that. So how we think about markets is, look, we fundamentally want to build companies that are iconic, large companies. And we invest for 7 to 10 years at a time in a company, right? These aren't 2-year investments or 3-year bets or 4-year bets. So when you look 10 years out, an iconic company for us is one that's profitable, that's $1 billion plus company, $100 million plus in high margin revenue, let's say. And to do that, you need to be in large markets. You can't have a large company in a small market. And so for large markets, we tend to think of markets that have sizes that are in the billions of dollars over time. Right, and an example would be a company we have that went public last year. So a lot of the information is public. A company called Indian Energy Exchange. It's an online marketplace for electricity. Now that's $100 billion plus market in India. It's all of you and us and factories and commercial buildings buying electricity, right? That's a large market. Like if you can take a piece of that and derive revenue from that, that could be a large outcome. Those are the sizes I'm talking about. Like grocery in India is like a $300-400 billion market, for example, and so on and so forth. We're talking about the tens or hundreds of billions of dollars.
And that comes from our compulsion to ensure that each of our companies, right, can return the whole fund. And that's one size is one big filter. Right? You mentioned online education, right? How do you select a market where lots of companies have failed in the past, right?
Yeah.
And also the market leaders, right, are also not very big in size. Practically, not too many companies in India who have more than 500 crore in education revenue, right? Not no single entity. So how do you still decide to go ahead and pick, what are the factors that you look out for, saying that this is the right time for the market to behave very differently than the last 10 years?
Yeah, in an early market where there is maybe no market, or where there's been a lot of roadkill in the past and still no market, some of the other factors we talked about, we rely a lot on founders, and we look for missionary founders who are not about the quick buck or a 5-year run, but they're on a 10-year or lifetime. This is their mission in their life. They want to be the best educator online, or they want to be the king of social media for some reason, or they want to be whatever, right? They have a long-term ambition here, rather than I'm doing this more clinically because there's a little gap in the market open for the next 5 years and that's it, right? So we think about founders, but when it comes to market, we also look at filters, and we develop a thesis on the market. So I don't know if some of you have the time or position or have time to do this, but we develop a view on a market. We call it a thesis, and we do it by talking to lots of companies, but more importantly, let's say education, we would go talk to teachers, to owners of schools, we would go talk to students, and we sort of just understand what is going on right now in that market broadly, and the problems in that market, and we develop a thesis. In education, a thesis we developed 4 years ago, and then again just before we invested in Byju's, the thesis was we want to do only B2C education companies, because selling to and through schools is a disaster. It takes forever, and schools are essentially small businesses, so it's not a great go-to-market. The second thing we wanted was a brand, because building an education brand takes 10-15 years. It's not like other spaces where you can get there a bit faster. You know how all these coaching institutes advertise that their kids got into JEE, right? That's part of the building the brand. But then you have to educate that kid, get them into JEE several years in a row, market that back to the parents. That takes time. So we wanted an existing brand. The third thing is we wanted a pedagogy that wasn't a copy of something offline. So the point is there's a filter. And even in an early market, even if there's been roadkill, if somebody fits the filter, that makes sense for us.
But the other problem that we have seen with markets is, for example, in India, right? You have these top 5 for large American companies like Amazon and Uber and Microsoft and Google and Facebook, right? I mean, they're supposed to take over every market in India because we're an open economy, right? How do you assess the viability of creating a large entity in that market, right? Even if assuming that you feel the market will become large, what makes you think that an Indian company will win this also, or will be able to win this market?
Yeah, I mean, I'd love to have your view on this.
Well,
I can also have a view.
I have the luxury there of running a very small fund, right? And my thesis was when I invested in ShareChat, right? A very obvious thing that, okay, why would Facebook or Instagram or WhatsApp not really try to kill ShareChat? Very, very obvious question. Why should we sitting in India with our small checks be able to fund Instagram or a Facebook killer, right? What the reason I thought was that we are 1/5 of the world's population. We might be an open economy, all that is fine. We probably are 1/3 or 1/2 of the world's techies, right? 1/3 at least, I'd say. Techies, programmers, and our kids are probably more expert at using the smartphones, because an American kid probably has 20 toys, a Nintendo or a small pad or a laptop or desktop, all of that, and also plays a lot of outdoor games, whereas our kids just play on the smartphone, right? So they're probably bigger experts, right? So, and then when you see some other markets, right, and not particularly in US, there are not too many competitors to the Facebook bouquet of social media products, but in China and in South Korea, interestingly, there were multiple social media companies coming up, right? And in Japan also. So I said, there is a decent chance, just a chance, right, that somebody could do it. And then here probably exactly what they have said, that in these kind of situations you are looking for people who don't mind the really bad odds of succeeding, right? Really against the odds, and are really missionary, and don't want to pivot, don't want to sell software to Facebook, or don't want to sell software to corporations or to consumers. They will only build a social network and nothing else. And that's what we were looking for.
Yeah, even in the same investment, the way we came to it was we had a filter. we were thinking about content and media in India, and we said, this is before we met them, and we met a bunch of companies, and our filter was, number one, when it comes to content media in India, we don't want a balance sheet heavy model. And there's a model section, so maybe we're covering that as well here. We don't want a balance sheet heavy model. What's a balance sheet heavy model? It's what Netflix has, or Amazon has, or Balaji Films has in India, or whatever. It's basically producing the content yourself, hiring the actors, having the studio, marketing the content. That's a very capital intensive model that typically venture investors have lost money on if they bet on that model, right? Whereas the model we wanted was a capital light model, capital efficient model, where the content is produced by somebody else, right? On Facebook, on Snapchat, on ShareChat, content is produced by the users, right? Second thing we wanted was low cost distribution. Distribution is key in the media space, right? And again, when it comes to balance sheet heavy models, they pay for distribution. You see Netflix advertising, I think, on TV these days and on billboards and everywhere, and they want to be the destination where everybody goes, and they've got no other way of getting that distribution. And then Amazon is fighting with them with Prime to get that distribution. There's a lot of competition, and billions of dollars in India are being spent to get your two eyeballs to go to Netflix versus Amazon versus something else, right? So we wanted free distribution. How do you do that? By building in virality into a product so that people share with each other. So that was a filter for us. And the final filter, the most important one, was founders who get the market that they're going after. And I think this is where the defensibility to non-Indian companies coming into India comes from, where if you're running a playbook or that somebody else has run in another market, if you're trying to do what Amazon has done in the US and India, you know Amazon's going to show up in India and do that. If you're trying to run the Netflix model in India, Netflix is going to show up, or Spotify is going to show up. We have to run a different playbook. And you can only do that when the founders know the Indian consumer or Indian enterprise or Indian SMB in such an intimate way that the companies from abroad just would never know that. And the insight we got from meeting Fareed and Ankush and Banu on day one, I remember going back and talking to my colleagues saying, wow, we learned a whole ton about what people want to do in their local languages in India. I mean, we just didn't know. Good morning messages 3 years ago, we had no clue that this was a thing. But it's a thing. And many other things happen with that audience base. And so that, somebody like Instagram and all, will take a while to get to. And by that time, you build a moat, you build an audience, and so on and so forth. So that was
one tip for angels that I have and what I use personally is to do a lot of stuff hands-on and get out of your comfort zone in your personal life, because best ideas about how big a market can be when we try to be as close as possible. I mean, of course, we all live in our ivory towers, but as close as possible to real masses of India, right? And it's very important to go and sometimes go to a grocery store yourself rather than sending a servant or somebody else to pick up grocery, because that's when you go and see what all people are buying, right? Just do some of those things more often if you really want to be a successful angel. There's one particular reason why people in Silicon Valley, very successful investors, continue to lead a so-called middle class life, because they're more connected to normal people.
Yeah. One other tactic may be helpful for you all in doing your diligence is, in a consumer company, we ask for 10 random customers and we call them. I mean, it sounds very basic, but I mean, it's amazing. Even 5 calls, you can learn a whole lot about what people think about a company. Not just 5 happy customers, but 5 people who've stopped using it. We also ask for those, and we call them and say, why do you stop using it? Within 5 minutes, you'll know. It's pretty straightforward. Within 1 or 2 hours of phone calls, you will know. It's not rocket science at the end of the day. And if they're selling to businesses, call those businesses and so on. Okay, so I'll move on to the next one.
Can we move on?
We talked about model.
You have a question? Okay.
Market is a category defining disruptive product. There's no market. How do you
There is no market for it.
You want to just repeat the question?
He's saying if this is a category defying, disrupting thing, there is no existing market for it. How do you estimate that? There are always alibis, right? So what would be an example? I'll see if I can.
For instance, the whole iPad business got created, right?
iPad businesses, right?
No
No, not true exactly, because the alibi there was laptops. A very clear alibi for iPad.
No, not true, because it actually failed few years ago when tablet was launched by Dell and somebody else.
Newton and so on. Yeah.
That's true for practically all iPhone products. They were not the first ones, but they were probably the best ones to put things together. All Apple products. But you know, if I give an example of how big can Uber be, right? There are two ways to imagine this. One way to see is how many people take cabs, right? Or another way is to how many people take car to office, or even better, how many people just commute, right? So there are three layers, and you can see, okay, what are the three layers? You know, where do you think it can go, and that will then depend on the opportunity and the founders. Right? And I think what Uber is aiming for is who all commute, and that's my market. Right?
I'll tell you one mistake we've made in the past in terms of assessing market size in new categories, like you mentioned, and I'll just say what I think a new category is. So, for example, before Ola, Uber came along in India and companies like them, let's say online ride sharing or cabs was a new category. Now, people were obviously taking cabs forever in India, right? So taking cab rides is not a new category, but the online enablement of that is a new category, right? So I'm just making sure I'm on the same page as you. Let's assume that was a new category. A mistake we could make in that category, or in online retail, or in online travel or whatever, would be we look at statically at the market as at the offline market the way it is today. We look at the cab rides market today or whatever it is and say this is the size, this online company will get a share of that, and then you do your assessment. What we have made a mistake on in the past is sort of being static about it, because what happens with sort of a lot of these marketplace businesses and all, which is all the vogue in India, is that they open up new use cases and they expand the market. So today there are people who take cab rides to go to the office, right? I mean, I would assume that historically wasn't the case, but because it's so easy and it's a bit cheaper, people are taking cab rides. That's expanded the market for cabs, right? In the US, if people are going out at night with friends, historically, it wasn't usually a cab ride. You know, everybody would drive, park wherever, and then whatever, right? Now take a cab ride. Why not? It's a great use case. In Oyo's case, which is a hotel management company that we've invested in, the use case has opened up. Friends are watching the World Cup together by renting an Oyo room. They don't have to make shor sharaba in their homes. They can shout all they want, and then they're done. So there's these new use cases open up in all these cases that you never would have otherwise thought about if you're thinking statically. So sometimes these markets are bigger than the offline market. That's the thought there.
Absolutely.
Okay. We talked about model already. I think one additional concept I want to bring is the same market might be attacked with different models.
Full stack versus marketplace.
Full stack versus marketplace is one. Today we're seeing marketplace plus software as one, or market platform as it's being called. In the digital media space, we're seeing this balance sheet heavy model, and we're seeing the capital light model. Almost every space you look at, like in the cab space, there was the Meru model, which is you buy cabs and you own the cabs and you run them, or there's the Uber model where you don't own the cabs and you build the marketplace. So there's different.
There is a little bit of a pattern there, Dev, I feel, where in the early stages of the market, right, when the market is not mature, the suppliers are not mature, the ecosystem is not mature, if there is capital, companies try to do more the full stack model where they're asset heavy. For example, like, you know, when you invest in Fresh Menu, and I invested in Fasos, and Sequoia then came in. So, you know, in those days, the marketplace model in food was not ready because the suppliers were not ready, people were not ready, packaging and, you know, various things, including the delivery infrastructure, the riders were not around. But as the market has evolved, we've seen that later entrants with marketplace model have actually raised up faster because the market has now evolved, right? Both have their merits, right? A full stack model typically will behave like a brand, will have more deeper consumer affinity, and typically more valuations on revenue.
Higher margins.
Higher margins also, and more revenue multiple in terms of valuation.
I don't know about that, but yeah.
But at least higher margin. Right?
Yeah, higher
definitely
margins.
Higher margins. Whereas marketplace models can grow faster because they leverage somebody else's infrastructure and capital. And so yeah, that's the difference. There can be hybrid models. We talked about Zomato, which is a hybrid of media and a marketplace.
Yeah.
And we are seeing some of these hybrid models where Netflix started as an aggregator and is now moving on to a producer. And Amazon, of course, is the mother of all hybrids in practically.
Amazon's everything.
Yeah, it's everything.
So I guess the point here is know which model you're investing in clearly and understand what are the winning characteristics of a company with that sort of model. So for example, if I was investing in a full stack food company, right, I'm not necessarily looking for, I'm looking for different things. If I'm investing in fresh menu, I'm looking for different things than when I'm investing in, if I was investing in Swiggy. We're not investors there, but if I was. You look for different characteristics in the management team, for example. If you're building a brand as a fresh menu, you want to be a little bit different than the team that's building a marketplace business, right? So there are differences in team. The differences in team, the differences in go-to-market strategies, the differences in capital intensity, valuations, and where you can raise capital from, and so on and so forth. Just know which model you're investing in. Not all food tech is the same. Not all e-commerce is the same. Not all social media is the same. There's variances in these models. And just know what that is.
I feel for a large market, and that's again the most important, don't do small markets. In a large market, sometimes the initial model is not important. In India, we've seen companies pivoting. For example, Lightspeed invested in Oyo Rooms. We're the first investor at seed stage, right? And just before that, I had passed on this company called Oracle, which is what became Oyo Rooms. And I was like telling Dev's partner that this is not fair, this is cheating. You guys pivoted after investing, this is just not done. So because I believed that the aggregation model probably was not right for India, and the full stack saying that you put your own beds and make the room look actually good, right, was the real model, which is what they did. But yeah, I think eventually we might see after, let's say, 10 more years, is that the Airbnb model actually starts to pick up, right, and not the full stack OYO model, which they are doing today.
Yeah, I mean, our view on that was that India is a low trust society.
Yeah.
So you're not going to allow people to walk into your home to stay in one of your rooms. It's just not going to happen. Maybe 10 years from now, but not now.
But how things change, for example, I was like really negative that people will not share cabs. They can take an Uber cab, that's okay, but Uber pool just not going to work. And just to see what, I just felt people are going to creep out, right? Uber pool, you don't know who's going to come in. And I took a few Uber pools, right? And I was like, I just couldn't imagine women taking Uber pools, right? And pardon for being whatever I am. I was the one who was creeped out because invariably, like 10 out of 10 rides, there was at least one women customer, or sometimes 2 or 3 or whatever combinations. There would be sometimes 4 people in one Uber pool. So I think some of these things change, right? And you can't really say that this model will not work.
Yeah, I mean, I don't know about that, the point you made on women, but I don't necessarily agree with that one. But I think the point here is that you never know what model succeeds, but just know what you're going in with.
Yeah.
Some angel investors we talk to go in with the point of view that, hey, I don't worry about market, I don't worry about model, traction, nothing. I just invest in the person. They'll figure it out. They'll change models, they'll figure it out. That's also valid as an approach. That's certainly not the approach we take generally when we invest. We want to know more. And we generally come in a slightly later stage, so we do have more to go on in some sense. So you have to make your own decision as to what your philosophy will be.
Yeah, that's true. I mean, if there are 3 things to pick from: market, team, and model. If I'm comfortable with market and team, I'd probably be open to the model being discovered eventually.
Right.
I'd relax a little bit on the model, but don't relax on market. I think that's one difference between angels and institutional investors, that we don't relax either on market or on team at all. Like very rarely would relax on either of them, whereas angels are more about the team.
Yeah.
Sure.
Cool. Any question on model? And as we move on, we've got about 30 minutes left. We've got about 5 or 6 topics to cover. Okay. All right. The next one is deal negotiation. The idea here, I think Anand, correct me if I'm wrong, was to talk about how do you talk to founders as to, I don't know, maybe it's valuation, maybe it's how much they're raising, maybe it's what they want to achieve with the capital, what they need to get done before you invest, all those sorts of, there's sort of a back and forth that goes on. And are there any best practices in that?
Yeah, I also don't know about, when deal negotiation is dependent, you would have read about negotiation, it's about leverage, right? As institutions you have some leverage, right? As angels I'm not sure how much leverage you have. We are a very small fund, so I practically have like 1/10 of the leverage that they will have. But we try to bring in some soft factors about what else you can bring, what has been your past track record and what are your references from other founders, whatever they are worth, try to put all of it on the table to negotiate. One good thing that will usually be helpful for angels is to talk to other angels who are co-investing and discuss valuation before agreeing. So if we find co-investors who are putting in, we say, okay, yeah, why don't we talk to the other investors and come back to you with an offer together, instead of making an individual offer for part of the deal, if you have to do that.
Yeah. I mean, I guess some concepts that we keep in mind is, one is, this is not a zero-sum game. This is not you win, I lose, I win, you lose type of situation. At the end of the day, the value is going to be created post-investment for the next 10 years, right? So the idea is to do something fair, and there are fair standards in the market in terms of the terms on most deals. I would encourage you to go, if you work with lawyers, just have them show you standard market term sheets, for example. Just learn what those terms are. Lots of blogs online that explain, and I'm sure on Let's Venture, where you can learn the terms and sort of what they mean and why they're there. At the end of the day, these terms have been arrived at after 100,000 companies have been invested in around the world, right? So there's a reason why this is fair, to balance risk between what the founders think is risk and what the investors think is risk, right? For example, there's a term that sometimes gets negotiated, which is how long should the founders vest their shares? How long should it take for them to vest their shares in the company? Typically we put in 4 years if the company is really early stage. And the reason we do that is both for our protection and the founders' protection. Typically, or not typically, I would say, in a large minority of cases, founding teams don't stick together for the whole journey.
Yeah.
They split up somewhere along the way. People have different visions, something else happens in lives, they have to go do something else, whatever, right? That's not an uncommon occurrence. Now if you didn't have this vesting term and all founders were 100% vested on day one, I could be a co-founder with you in a company, we get funded, tomorrow morning I say, Anand, I'm leaving, I got something else to do, I leave with half the company. Is that fair? Now he's got to work for 10 years to create value in that company. That's not fair, right? So that's why some of this vesting schedule isn't there, to protect the founders, but it's also to protect the investors. It could be that if I'm the investor and I invest in a company and all the founders say on day one, I'm leaving, then what is it? This is crazy, right? So this is a balance in the middle, right? Where the founders get to keep the equity if they stay long enough to build value. And typically the journey is going to take more than 4 years in any case, right? And we give them, and they get their equity over those 4 years, and we're also protected, right? So it's a balance in the middle, and all of these terms are balanced. So I would just encourage you to know why these terms exist, not just what the terms mean.
No, and I think most angels actually are pretty liberal about just trusting the founder on whatever terms he puts on the agreement. There are few instances where we see in the reverse, where angels expect a minimum return, which I find sort of meaningless, because we know that 9 out of 10 companies are not going to do well, which basically means zero salvage value, and practically true for my portfolio, that when the company goes down, there is nothing to salvage, right? And in those circumstances, a minimum return clause is meaningless. So instead of having those kind of clauses, I would think of things which are really material in a successful situation, right, or a ongoing company situation, where probably you could probably ask for more ownership. I mean, I just like 5 years ago we were competing with a very new VC fund where they gave a term sheet with a 3x liquidation preference, and our term sheet was very standard, like you said, thousands of term sheets, 1x liquidation preference, right? And it was such an easy thing. We probably gave 30-40% less valuation, and the founder, like without batting an eyelid, just took our term sheet, right? I mean, and eventually, of course, the liquidation preference didn't matter.
Yeah. I mean, the final thing I'll leave you with is I think I won't recommend dragging these sorts of negotiations over weeks or months or whatever it is. There's a relationship to be built here. Again, you're going to be working with this founder for several years. So do something that within 1 or 2 steps you're there, and be standard as far as possible, so that things get done. At the end of the day, the value again is being built in the future. You're not trying to extract some value right now. So
I agree, Dev. I mean, if something drags on for more than 5 weeks, we do these monthly meetings, and if something is dragging for more than a month, we actually take a hard look. Do we really want to do this deal, because we don't seem to be getting along? We can't arrive at a common term.
Questions? Sure.
Negotiation. So, for small angel investors, the ticket size is very small. Is there a play on negotiation? I mean, so
You mean, can you negotiate?
Yeah, is there even a possibility?
So the question was for angel investors, can you even negotiate, because it's typically...
Sometimes you're saying that the lead has already decided the terms.
Yes.
Yeah, I think there's no point in negotiating then, right? Because somebody's already set terms. You should talk to the lead and understand why he's agreed to those terms, right? Because that's an important input for your decision. But I don't think that if the guy has got like half of the deal committed, you have leverage to change the terms again.
Two things I would recommend is, one is if you're going to be doing angel investing as an ongoing thing, not just a one-off here and there, develop a relationship with a legal counsel lawyer who you trust, who's done startup financings before, who can look at a term sheet or whatever and quickly tell you what is off market and what is market on the term sheet, so that you know where the off market terms are. And if there are off market terms, in some cases even the lead might be willing to say, okay, let's bring this back to market. Maybe it's off market in favor of the entrepreneur or the investor, but let's bring it back to market. So have a relationship with a legal counsel. Use the same person again and again, because they'll understand your style and you'll get to trust them as well. So that's one thing. And the second thing I would say is, one thing peculiar to India is that even after term sheets have been signed, I find in India there's still some movement on the term sheets, on some of the terms. People still come back and say, no, maine ye nahi padha, ye badal do, and I found that initially very disconcerting, but now it's okay, a little bit okay, but I wouldn't go too far down that path, like wholesale changing large parts of a term sheet that's already been agreed to, because that it means you're not honoring the handshake that happened.
Because I've seen, terms like carry, which is very large in some of the deals, so does it really, can you
Carry
even negotiate?
What do you mean by carry?
The carry, I think some deals, when you exit, I think they have a carry concept where, the person who, so if you have 30 investors.
The lead investors.
Yeah, the lead investor have a carry, so.
That I think for you to negotiate, that is another part of deal negotiation. I agree with you.
Yeah, I'm not familiar with that.
I'm not familiar again either. Yeah, we do negotiate for our carry with our investors, but that's like over years and years of dealing.
And there's a standard that's developed.
And then there's a market standard for that, thankfully.
Would you have a list of presentation for any lawyers of this kind you were just talking about?
Any lawyers?
Yeah, lawyers,
Oh yeah, I think Let's Venture team will guide you to a lot, because there are at least 50 law firms doing startups today. Yeah, and practically I would have worked with 10 of them, or at least 10, 20. They're all equally good.
Don't go with your CA.
Don't go with your
Please
CA
don't
or
go with your
CS.
CA.
Yeah, I'm talking about small investors like us.
Yeah, don't go with your CA or CS. They will mess it up entirely. You need to go. There are a lot of small firms doing startup investing. In Bangalore, probably there will be at least 30, 40 law firms.
Yeah, and you might want to ask venture investors or others, like, what are the best. So develop a list of 3-4, go talk to them, pick one.
And there are some open term sheets, right? I mean, for example, our website has an open term sheet for our founders, and there are many open term sheets floating around, which you can just refer to.
Yeah, Y Combinator in the US has this concept called SAFE. It's a standard term sheet, and there's various such things you can look at. One last question, and then we'll move on. I'll go to the back. Since we haven't had a question.
You mentioned about vesting for the co-founders. How do you handle if there is only one founder and I'm planning to? Is the vesting for the founder applicable even if there is only one founder?
I think there still is, because then they don't have the incentive to leave within a year or two and take all the equity. It's still let's build value together, and then you
because
obviously
the
have a stake
founder
in it.
is vested, meaning he can't start another business, can't do another job, etc., etc. So you do want a vesting so that the founder is committed to this one company only.
Yeah.
Moving on.
So next one, we have about 20 minutes. We have co-investors, staying in sync with our exit negotiation. We have 5 things. Should we pick a couple of these?
Pick the exit one, I think. Probably. Or what do you want to talk?
Anything you want. Well, it's be hard to do a poll on this. Let's go with stuff that happens post an investment.
Yeah.
Staying in sync with founders, sort of deal management is what we call it.
Yeah.
I don't know what your philosophy is on that, Anand.
Yeah, so I think we do sort of play the role of a coach for the founder, right? And some of you will find yourself in that spot. Set up a table, a calendar, right? What we do is we have a strict discipline around MIS coming to your mailbox before the 7th. It usually ends up being 1 or 2 days late. Right?
Before the 7th of each month. Is that what you said?
Yeah, for the previous month, right?
Okay.
By the 7th of each month, the MIS should come. Some of our companies have live MIS systems for us to log in and see. But then you also spend face-to-face time, ideally once in a month, once in 2 months, and during those things, don't go over the numbers, right? Just talk to them face-to-face, see what they're going through, what they're thinking. Discuss about plans and targets, because founders need to get reminded about those. And just watch out for one co-founder not being involved or not liking it or having issues and all of that. Right? By and large, it's more about regularity. Right? You can't invest and forget about it, because otherwise what happens is, if you maintain a lot of distance between you and the founders, you will not know when, for example, you want to put more money, you will not have enough information, or when you want to get out, you again don't have enough information about the company.
Yeah, I mean, the couple of concepts I think are important here. One is, before you invest, have the conversation with the founders in terms of alignment post-investment. What are the key milestones that you want the company to hit by the time this capital runs out that is being raised? Right? If it's an 18-month time frame for that capital last, what do you want the company to achieve? If it's an enterprise software company, do you want to have them to have 5 customers and account expansion in 2 of those customers? Do you want them to, if it's a consumer company, do you want to have a certain DAU by MAU ratio, or do you want to have super deep knowledge about the super user base in that consumer company, or certain unit economics need to be proven? Whatever it is, understand what those 2 or 3 milestones are. Make sure you're on the same page with the founders as to what those milestones are, and that you're all gunning for the same thing. Because again, if you have different milestones or you haven't talked about them, then you won't know whether the company's hit them or not, right? Whether they've exceeded expectations or not. So just have milestones in hand. And when I say staying in sync with founders, I mean manage those milestones even post investment, because companies change. There might be pivots,
every quarter.
there might be, markets might change, whatever. So every quarter, I wouldn't say every month at these MIS related meetings, but once in a while, look at the milestones that you've hopefully written down somewhere before you invested. Look at them, meet the founder and say, hey, are we on track for this? Do you think these are still the right milestones, or have you learned something about the market or the business that we should change the milestones? And change them, write them down so that you can refer to them later. I think having it just in people's heads is the worst mistake, because you can always recreate the past in a different way than what actually happened. So just write down stuff and manage that, stay in sync with the founders. Deal management is super important, because it informs you on follow-on investing, on exits.
In fact,
most
of your learnings for how to do the next deal also comes from, a lot of information comes from deal management. Right? A lot of stuff you learn about the whole market or a sector, or how to select founders, is after you spend time with and remain in sync with the founders.
Last concept I'll leave you with here is that know why you're angel investing. Again, I'm not an angel investor, but from the outside in, I think there are a few reasons. One is, you could say, I'm actually not going to stay involved with the companies. I'm just investing because my friends are asking me to invest. Maybe that's a reason, right? Another one might be, I've come from the tech market, I've done really well, whatever it is. I want to be really involved and help my founders. Right? Know that's why you're investing, and there's a different strategy for that. There might be a different strategy where I may not be helping the founders as much, but I'm in this for the financial return. Know that you're doing that, and then that dictates a strategy on a bunch of these different things. So know what it is. I hope it's not a mix of all three, because then your responses might get mixed, but just know what it is and invest accordingly.
Absolutely. Dev, actually that links to one of the other topics about picking co-investors, right? You need to know why your co-investor getting into it, right? Because the objectives, sometimes, if another co-investor or another angel who's referring you to, he has the only main thing is ki I myself want to solve this problem, right? And this founder is doing, so I want to be a part of it, which may not necessarily have a lot of financial thought around it. So it's useful to know what are the motivations of other co-investors, right? What is the horizon? What are they looking out for in this deal? And that's how ideally you'd pick up. But there are lots of other things about co-investors.
Yeah, I mean, just be aligned. Have the conversation again before you invest. Have the conversation with them. Where do you want this company to be? Like, do you think they want to raise a lot of capital? Are you going to do you think you're going to invest in those rounds, or you're done? You just one shot and you're done. Like, just understand that, because then that affects. Maybe some people will want to exit at a certain stage. Some people won't. If there's an acquisition offer that comes with the company, some people will say yes, great. Other people say no, I want to wait for this company to multiply tenfold more in value. Just understand that you might have different motivations on the cap table, and understand how people will behave. Investors will behave differently depending on those motivations.
Dev and I are co-investors in ShareChat, and one thing which was really common between us is when I asked Dev, when do you think the company should do revenues, right? It's a social media company. They can choose when to start advertising or when not to start. Dev said, yeah, there's a long while for that to happen. Probably a few years once we reach critical mass, and then we'll evaluate, right? That was very different of a reply from many other investors that the company was talking to, and that was really, really comforting. And when we knew that we got, at least on the milestones, that part we are completely aligned, right? That was very, very comforting. It's important because you don't want different, completely opposing views on the board about these things, and sometimes these opposing views are difficult for younger founders to sort of mediate and find a way out of.
Yeah. Any questions on co-investors or staying in sync with founders or deal management? And the back there in the yellow, yeah.
I have a question. Probably it's not too valid for institutional investors, but from an angel investor perspective, where we often get stuck is to come at sync with the founders on the amount of funds that they need to raise on that particular round. So it's become a fad when they come in and say, I need $1 million. But do they really need $1 million? It's very evident. So I personally find it very difficult to negotiate with them that they do not need that money to reach that milestone that they would need to reach to go to the next stage. What would be your thoughts on that?
Good question. We haven't covered that. Go for it.
Yeah. Go ahead.
So, we typically write checks of like a few crore rupees, which probably is the range we're talking about. What we basically say is that the major aim of the company is to raise the next round of funding, right? A proper Series A, right? And what would it take, right, in terms of number of months? In terms of number of amount of proof required, right? So, for example, let's say you assess in ShareChat that you probably to prove something meaningful in one language, you need to have, let's say, 100,000 or 50,000 daily users, right? Let's say that's the amount of proof that you think will get you a Series A, right? And then you work backwards saying, or for example, if it was, let's say, a taxi operator, you're saying, okay, can we have one city operational with this round, and can we have some performance metrics or regularity or repeat proven? And then you work backwards, how much time will it take for us and how much capital investment. You have to fund that much plus 6 more months for the company to survive, because typically a company takes average time would be 12 to 18 months to raise the next round, right? Some do it before 12 months, but I'd say fund a company for at least 18 months. It's risky to fund a company for 9 months or 12 months. So, but yeah, $1 million sometimes maybe longer than what the company needs for 18 months.
It just depends on the model, right?
Yeah.
If it's an e-commerce company that's going to have warehouses and logistics, it's probably going to be a bit more capital intensive than sort of a social media company or a content company, for example. So it just depends. I would echo Anand on saying fund 18 to 24 months. Things will always take longer than you thought. And what you don't want to be caught in is a situation where you haven't reached the milestones that you've all set together. You need 3 more months, but you don't have to. Raising 3 more months of capital is almost impossible.
In fact, it is also impossible for institutional investors to fund more, right? So we are cautious. Sometimes we give founders more than what they ask for, because we don't want to be in a situation where the company is stuck and you go back to your investment committee saying, want to do a bridge round.
Yeah. But I agree, $1 million, there's no magic answer that everything has to be $1 million or $500,000 or whatever. It just depends on the situation, but it should be strategy and milestone driven, as opposed to that's $1 million is what the market is doing. I think that's kind of crazy.
Just one add point to it.
Yes.
Would you want to check out, would you want to comment on the attitude of the startups if they refuse to kind of go into that negotiation?
Well, yeah, you like we talked about founders, right? You have to like them, right? And ultimately, only likable people will make a lot of money, right, in the long run. So, having said that, sometimes you might want to meet somebody multiple times before making a judgment, right?
Yeah, I mean, again, I would say it depends on your philosophy as an investor. Look, as an institution, we're going to be investing for the next 20, 30, rest of my professional lifetime. I'm going to be investing. I hope I have that privilege to do that. It's not worth doing it with people you don't enjoy working with, because you're going to be working with each company for 10 years at a time, right? So you might as well like them, and not only like, I'd say be in love with them to begin with.
Absolutely.
Otherwise, what's the use, right?
There is already so much of attitude in the boardroom with the VCs that you don't want the founder also to have attitude, right? It's too much to have.
Final question. I don't know microphone.
We'll repeat the question.
I had been a CEO in an insurance company. Now I am heading a broking company, an insurance valuation is broking. I just wanted to know a couple of things. I mean, it's slightly personal also, one of them. In the insurance segment, it's about a 1,50,000 crore market. I mean, the non-life insurance.
If you could just keep the question brief so that we can answer it.
So the other thing is, possibly we just got 8 minutes on the screen here. Can we do this offline?
We can do that.
Yeah, we'll do that afterwards. Great. So one other area we wanted to cover was crucial relationships. Again, assuming here that you're in this for financial return over the long term, and you're going to make many, many investments over the next several years, we just thought it'd be interesting to just talk about, other than angel investors, who else should you be in touch with and why? We already touched a bit on the lawyer piece, right? Have one person, not a CA or CS, a regular startup venture lawyer who can help you, that you trust, that understands the market terms and can help you there. Any others?
I think one thing that has helped me is to have relationships. I have seen angels having a relationship with some well-known founders, because it's very convenient to pick their brains and even maybe get help in connections. Definitely have some relationship with VC analysts. It might not be possible for VC partners to give you a lot of face time, but for example, if you're investing in a particular company and you want to find out how many other competitors of that company are there, if you have some people who are friends who are working in VC firms, they could simply tell you, hey guys, I also saw 5 more deals in the same space, right? Which you may not be aware of. So you have to build some information sources around yourself, and of course some sources for advice, legal or otherwise, even investing advice, and some people to help you in deal management after investing, people who are founders of companies and who can maybe tell you about what to do in a particular situation in a company.
And all this assumes, I think, that you're going to be a more involved angel investor. If the philosophy, which is also valid, is that you're just going to write checks and forget about it, and 10 years later figure out if anything happened, then you won't need to do a lot of this stuff, I would imagine. But again, just decide what you want to do.
Some of this is important to people who are spending substantial amount of time on angel investing.
Yeah. One other set of relationship I think is important if you want to be full time on angel investing is with VCs. Have the relationship. I think 2 things to keep in mind. One is as VCs, we do seed rounds and Series A rounds where sometimes we want to bring in angels. I mentioned this before.
Yeah.
And your relationship with them will mean that they will think of you when they want to have those angels come into the round. That leads me to my second point, which is that stand for something. Like as an angel investor, have a brand out there or build a brand in something. There are angel investors, founders that naturally have it, because if I've built a successful e-commerce company, then other e-commerce company founders want to get funding from me, hopefully, right? If I'm a executive from Hotstar that's now angel investing, other content companies and distribution companies would want to get investment from me, hopefully, right? So there's a brand there. But then if you don't have a brand today as an angel investor, or you're coming from outside the technology space, stand for something. Have a strategy that you can then explain to people. I want to do only investing in a certain sector because I've got a background in it, or I have friends who are in it and I've learnt about it. Or I want to do only investing in deep technology companies across different sectors, or something. And then build that network, the set of relationships, sourcing, everything around that, so that you're tuned into that. That would be my view, at least, from the outside looking in. As opposed to, it doesn't matter what it is, I just do whatever. I think that's undifferentiated. So when others do a round, they don't know if they should call you or not into that round, because you don't stand for anything. That would be my view, at least.
Yeah. It's a little slower, but typically I think investing career, even as a hobby, is like, you spend a few years to get into it. So it's good to have a plan of what you plan to do the next 3-4 years. We have very few minutes.
Yes.
I
we have
want
one last one. Yeah. Oh, you want to cover something else?
Exit decision,
Okay.
just one thing was like, as an angel, what I have learned, I have sold some of my picks very early, and my lesson is that if you find a good company, and if you are convinced that it's a good company, there is nothing wrong fundamentally with the company, it's never overvalued, and it's always too early to exit. If you find a great company, you're very happy, the company is growing, fundamentals are good, you probably want to stay on as long as possible, unless you have a specific need for cash. That's my lesson about exit decisions.
Yeah, my view is that at least we view angels who are coming in with a 1 or 2 year timeline, saying we want to exit at the next round. We view that quite negatively.
Yeah.
Because at the end of the day, any new financing that's coming into the company, we'd rather have it go into the company for growing the company and making it more successful, rather than not siphoning off, that's a negative term, rather than buying out secondary from existing angel investors, right? So I'd rather have that be the case. And so I think this get rich quick thing that we saw a little bit of in 14 and 15, I think I believe is not the right way to go into angel investing, because things take longer. You will leave a lot of value on the table if you want to get out in 1 or 2 years. There's a lot more upside in successful companies.
You don't want to cap the returns of your best companies, right? I mean, the bad ones are anyway not going to get you anything, but you're capping the returns on your best companies.
Yeah.
Deepika, we're going to take a few more minutes to talk about current themes.
Yeah. The last one we wanted to go on was just leave you thoughts on what is active in the market. Now, obviously, there's a lot of press on this. People blog and tweet and etc. about this, but we just want to bring it up to an abstract level. I'll start if that's okay with you, Anand.
Sure, please,
okay.
Absolutely.
So the commentary I'll give on this is that as investors, and I've been investing now since 2006, is that there are windows for investing in any space, right? For example, as seed or Series A investors, so early stage generally speaking, or angel investors, it's not that every space remains a white space forever, right? As companies start getting funded into that space, it starts getting crowded. At some point, there's enough companies that have proven themselves. You don't want to be yet another early stage company in that space. So there's windows that open up and close. Sometimes the windows open because there's a new platform that comes along. For example, Alexa and Google Talk, Google Audio, what is it called?
Yeah.
Google Home. That platform has just come along. So there's a set of seed and Series A fundings that are happening in that space. Applications that can be distributed through Alexa and Google Home. That's an open space right now. Whereas if I look at horizontal e-commerce in India, I would generally think that's not an open space right now, right? Now, horizontal e-commerce and commerce was an open space 2009 to 13, let's say.
Yeah.
That's when the seeds and Series A's were happening then. 14 and 15 is where a lot of the on-demand companies got funded. So on-demand food, on-demand transportation, on-demand hotels, on-demand logistics,
including
hyperlocal stuff. A bunch of that on-demand got funded and overfunded actually.
Yeah.
And then in 16 and 17 what's happened is a lot of those spaces stopped getting Series A and seed, and they consolidated. The winners in each of those spaces have started emerging. In home services, you've got Urban Clap, for example, and there were many spaces. We were investors in other competitors that didn't work out. In e-commerce, we've seen the space consolidate from 50 plus companies right down to a few, and so on and so forth. So the new themes that have opened up now, Anand, maybe you want to comment on some of those?
So, I think the same window. I think one thing which I believe has a longer window is leveraging the India stack. Right? I mean, fintech largely. So you talked about insurance. I think that's one theme which is, I think, open for a longer window, because the market forces and the existing competition is not able to fight back right now. Because of penetration of internet to really rural areas and very high quality infrastructure, we are seeing agri coming in with growth of e-commerce, etc., and in general overall growth in connected commerce. We are seeing logistics as one big theme.
Yep.
And of course, what we love in media. And
media is growing.
Media.
I think we see B2B marketplaces an interesting area in India. That window is open, I think, in certain verticals. B2B SaaS or SaaS used by Indian companies, certainly early there.
Yeah, is there.
A lot of people say it's never going to happen. Indian companies are never going to pay, but it will happen. So that's an early window that's open. And I think one other concept that we talked about before the event that you brought up was very interesting, which is, what about investing pre-window?
Pre-window. So I think, I'll just give an example. There was this thing called Google Glass, which is supposed to, right? I mean, and I was like
these
the glasses where you can see connected spectacles where one of the glasses will show you some picture, right? I thought actually could be a revolutionary technology or not, right? The right time to invest was when Google Glass was more of a concept, right? It did not really succeed. Snapchat, etc., tried to come out with some form of glasses, but like Google Home, for example, right? There is always a window. I mean, ShareChat, for example, right? We believed in ShareChat before Jio happened. I invested well before Jio happened. They also invested practically well before Jio happened, right? And we waited for like a year for Jio to roll out, and then we were actually in the right spot. We had the right team. We knew a lot more about the market, and we could leverage it. Right? I mean, so you do want to, particularly if you are a good watcher of technology and you have some fundamental beliefs, right? I bet on lending card and some other fintech companies way early in 2015, when India Stack was in very early days, and you had to do a lot of workaround. It wasn't really a hardcore tech company, if you will, but in 3 years things have changed. So sometimes you want to get in early, try to do what we call as jugaad or a workaround, and then wait for the window to open.
Yeah, and I think the point here is that as angel investors, you're going to be coming in very early.
You have to be very
You don't want to be coming into spaces that are crowded. So you'll have to have a little bit of a nose for what is coming as opposed to what's already happening. And the way you do that is with some of these relationships. On Let's Venture, there'll be a bunch of companies, different spaces and verticals. So just be a little bit early. That's what you get paid for. That's what you get the returns on, rather than being in a space that's already very active. The last question, and then we'll wrap. Somebody who hasn't asked a question yet. Anybody has not asked a question?
Okay.
In the back there.
Yes,
yeah. That'll be the last question.
How about AI, blockchain, more deep tech currency?
Yeah, those are technologies, right? What is important is the end application, and you still again have to look at the market, again have to look at the model, again have to look at the team, right? There is no such company as an AI company. Right? It's an application using AI. So.